In this article, I hope to make a brief distinction between a traditional life insurance versus variable life insurance. This is so you are clued up on what type of insurance plan matches your financial requirements, lifestyle and risk tolerance. By the way, thank you for watching Ricky Avelino's YouTube channel. Enjoy learning. Traditional life insurances. Examples of traditional life insurance are permanent, whole life, endowment, and term or temporary. Offer high level of savings within a specified term of years or can be whole life. 3. Can provide guaranteed cash values and has dividends for participating policies. No changes or addition in premiums are allowed to increase maturity benefit. They have definite protection and death benefits and are stated at the inception of the policy. Do not have highs and lows of investment returns and its death benefits are guaranteed, except for the dividends component. Variable life investments and insurances. Types of investments are fixed income securities, cash deposits, onshore accounts, government bonds, T-bills, T-bonds, corporate bonds, debenture, secured, convertible, shares, equities, common trust funds, unit investment trust fund, mutual funds, real estate. Are more suitable for those with medium to high risk tolerance. These are for policy owners that are not risk-averse and who can tolerate risks of short-term fluctuation in their investment and policy values. For variable life insurances, it offers potential for higher returns but at the expense of market volatility and higher degree of risk. One can give flexible premiums with returns that will vary in these investment-lined, unit-linked and equity-linked types of variable life insurances. Investment returns are not guaranteed and will fluctuate based on the rise and fall of market prices. These have clear structure on which caters separately for both investment and insurance protection. The withdrawal and protection benefit are determined by the investment performance of the underlying assets. No policy loans are granted to policyholders, but partial units of the investment can be withdrawn anytime by selling it back to the life insurance company. 9. Additional investments are allowed anytime. In example, you initially invested $100K into a mutual fund, unit trust fund. You can add on additional amount if you want to increase your pool of money and maximize high yield. Variable funds provide a highly diversified portfolio, thus lowering risk of investment. The fund relieves the investor from the hassle of administering his/her investment. The fund enables small investors to participate in a pool of diversified portfolio even with low investment capital. When claiming death benefits, one can choose the full withdrawal value or the guaranteed sum assured, whichever is higher. 14. The impact of changes in investment condition on variable policies is borne solely by the policyholder for revocable. The volatility of the returns depends on the investment strategy of the fund manager. Have a larger exposure to equity investment than with other traditional policies. Funds can be switched as deemed fit by the policyholder. For proper financial planning, you may contact your trusted financial advisor. If you want to see more videos like this, hit the like button, subscribe and leave a comment for any suggested videos or questions.